You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this Investing Matters podcast. My name is Peter Higgins. You can find me at Conquest3 on Twitter. And today I have the huge privilege of speaking with Richard Stone. Richard is the Chief Executive of the Association of Investment Companies, having joined them in September 2021. Prior to that, Richard was the Chief Executive of Share Plc, the Share Centre platform from 2014 to 2020, and was the Finance Director from 2006 to 2013. Richard, you've got lots and lots of experience from tech to being a financial controller to floating a business on AIM. What made you want to join the AIC? You know, having sold the company to the interactive investor and the behemoth that then took that on from Abrdn.
Yeah, hi Peter, good to speak to you. Yeah, I mean, as you said, I've got quite a background in various aspects of, I'd like to think of it as various aspects of capital, really. So whether that was being kind of an auditor right back in the early days through to being an equity research analyst, or more recently running the Share Centre, clearly, you know, quite lengthy exposure to sort of the retail investor in particular. And the AIC kind of seemed like a really good next fit. At the Share Centre, we did a lot talking about retail participation, access to markets, all of that kind of stuff. And you know, the investment trust structure was something I was very familiar with. We'd acquired a number of the old investment trust savings books that the asset managers used to run. And so, yeah, it was something I was passionate about and kind of made a good fit, really. So delighted to have joined here a couple of years ago, and it's been busy since, so which is always good.
Brilliant, brilliant. Now, I'm going to go back now to the fact that, you know, we've shared it, we've done a bit of research, we've got some information here. And it seems to me that this interest in investing per se for you started very, very early on, even as a teenager, maybe.
Yeah, it did. Yeah, I mean, I remember quite clearly when I was at school thinking about just the idea that you could own some of the companies that you interacted with around you. I guess that was the sort of the genesis of it. And I used to be fascinated. This is going to start to show my age a bit now, but for those of you who remember CFAX and teletext, for example,
Oh, yeah.
do you remember?
That's
Do you
me as
remember
well.
they used to? So do you remember they used to have the share price pages, and you could see, and you could see. I mean, this is we're going back pre-internet here, so this is you know, you
Absolutely.
could see the share price movements, and it, you know, they were published in the paper every day or whatever. You know, there was a certain kind of level of excitement, particularly around equity participation, I suppose, and the idea, as I say, that you could own a bit of that business, and that was you know, something that as a kind of ordinary person you could do. So yeah, I suppose that sort of sparked the interest. And back in the days when, as a child, you're thinking about, oh, what do I want to do when I grow up? You know, the idea of, oh, being a stockbroker kind of seemed like quite a fancy career. That wasn't until I then did some work experience in my fifth year at secondary school. I did some work experience with a firm of stockbrokers, Brown Shipley, I think it was, and I came up to London and I went onto the floor of the stock exchange, and this was shortly after the Big Bang, and the guy said, whatever you do, don't go into stockbroking because it's just all about to massively change. And needless to say, well, I think all the open cry had been taken out by that point. Big Bang was just kind of happened. But yeah, it was an industry that was obviously going to go through fairly major change at that point. And you know, however many years later, ultimately ended up working for a retail platform. And you know, what the internet has enabled, the ability of people to trade from their home and do it all themselves and stuff, you know, is phenomenal now compared to what it was back in the 1980s. But also bear in mind, I'm a child of the 80s, so therefore you had the time when it was the big privatizations. You had BT and British Gas and Telcid and all of that kind of stuff, which sort of significantly piqued the interest for somebody who was in their formative years studying economics and seeing all of that stuff going on around them. So yeah.
Absolutely. So you had an interest, and then you took that on. You attained your A levels. Which university did you go to, and what did you have in mind as to this is what Richard Stone wants to do once he's finished qualifying with his degree?
So I was one of those people who I suppose was slightly unusual in knowing what I wanted to do, which was to go on and be a chartered accountant at the time, because um, again, I'd done a bit of work experience with a chartered accountancy firm, and I enjoyed it. I particularly enjoyed working in the insolvency department for some reason. But that was, I think, in part because as the insolvency practitioner, you kind of walked in as the chief executive almost, and you had that kind of you were then running the business, trying to turn it around, trying to make something of it, a business that had got into difficulty. I quite liked that piece. But yeah, so I wanted to be a chartered accountant. But the choice of university really came down to the course. So as I said, I enjoyed my economics. I did politics as well. I wanted to carry both of those on at university. Decided that doing PPE was a good degree choice. Oxford wouldn't have me, so I ended up at York, which was the only other place that did it in those days, in that way, teaching the three subjects separately. So I went off to York and did my 3 years in York, and then joined EY and qualified after that. So yeah, it was good.
Yeah, I think York made a good choice there of you, Richard, I
Yeah, it
must
was a
say.
good place. It was a good place to go to university, and it was a good degree course. I really enjoyed the whole, the mix between politics, economics, and I like, with teenage children myself now, I'm sort of trying to encourage them to think about multidiscipline degrees rather than just a single subject degree. I think it's good to have a bit of breadth if you can, unless you're particularly passionate about one subject. But I think it's nice to have that breadth and see the interaction between subjects as well. And clearly between economics, politics, and philosophy, there's a fair degree of overlap as well. So yeah, no, it was good.
Fantastic. Now, whilst you're qualifying, you then gain the qualifications as a chartered accountant, and you went on to win the Pete Prize, not my prize, the big prize, the Pete Prize. Can you explain what that is? Because it's an outstanding sort of a national accomplishment in that as well at such a young age.
Desperately nerdy. It basically means I got the top mark in the final exams when I qualified to be an accountant. So basically, of all the people that of all the people who sit the final exams, the person who gets the highest average mark across all their papers gets the Pete Prize, which was obviously sponsored by the Pete, as in KPMG, Pete Marwick. So yeah, it was quite an honour. I'll tell you a slightly funny story though, because this predates the internet again. So in those days, we didn't get our results through the internet or logging on anywhere. You basically, they were printed in the Times newspaper on a Saturday, and so people used to come up to London and go to Charing Cross and get the paper at 10 o'clock at night or whatever when it first came out. But I was living out in the sticks at the time, and I qualified in Reading, so living out in Reading, and or near Reading, and EY used to pay some of their junior staff in London to go and get the paper and then man a telephone line, so you could ring them up and they would then look you up in the paper to see whether you'd passed or not, which was fine. The prize winners box was a box in the middle of the page, so your name appeared in the list, but if you're a prize winner, it was also in the box of the page. So I rang up the phone line. Yeah, they checked my name. Yes, I'd passed. Da, 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 da. But that was it. The Friday night, I knew no more than that. Saturday morning comes, two envelopes arrive in the post, a large one and a small one, and I thought, well, the large one must be, I don't know, the papers for joining the institute and all the rest of it. The small one will be the results. I opened the small one and it had told me I'd won this prize. So yeah, it came as a pleasant surprise. But EY send you out to sent you out to private tutors to help you get, to pass your exams and all the rest of it. All of the big accountancy firms do the same. In our one class in Reading, there were 5 out of the top 10 people in the country that year. So
Fantastic.
it just goes to show you how that kind of from across a number of different firms. But yeah, that one class had 5 of the top 10 in the country. So that was quite something.
That is a fantastic achievement. Brilliantly well done, and congratulations to you on that as well. So you're at EY, and then you decide, you still got the investing bug. What happens next regarding your interest in investing that led to the next career move as a equity analyst?
Yeah, so I'd been auditing for 3 years. I'd kind of had enough of auditing, and those big audit firms are quite time-based in terms of their career progression. So, and I was a bit frustrated by that as a sort of young and eager 20-something-year-old. And I also wanted the opportunity to come up and work in London for a bit. So the opportunity arose to join an investment bank as an equity research analyst, which kind of combined that interest in economics, the sort of slightly bigger macro stuff, as well as at that time I was predominantly auditing technology companies. The Thames Valley was supposed to be the next sort of UK Silicon Valley. So a lot of our client base was in technology back out in Reading. So I'm moving up to London to become a software and IT services analyst for a US-based tech investment bank seemed like a great move. And this was well, I kind of accepted the job end of 98, joined in 99. So you're kind of 99 through 2000. And I mean, by February 2000, I think I was working on 8 IPOs across Europe of different IT services and software businesses, and names which were the precursor to some of the big names these days. You know, people like QXL Ricardo, which was kind of an eBay type model, or FreeServe, which was you know, one of the first internet ISP providers. You know, that all of that kind of stuff. So yeah, it was exciting times. That kind of the end of that sort of dot-com boom, if you like, and then down the other side.
Mm-hmm.
So yeah, it was fascinating, informative, and some of the stuff in the atmosphere in London at the time was crazy. So yeah, it was good.
Fantastic experience there. So after, I think it was Robertson Stevens,
Yeah, that
you
was it.
then move on to work at EC Soft. Is that correct?
Yeah, so that
It's
was a
dual
jump
listed
across.
NASDAQ.
Yeah, so
Yeah.
that was a jump across.
So
So
tell us about that.
EC Soft was a Robertson Stevens client, and they basically were dual listed
Right.
NASDAQ
Okay.
and the LSE. I'd followed them
Yep.
as an analyst, and so I left. When I'd left Robertson Stevens, I joined them as a financial controller. That was my kind of jump across into industry, if you like. So
Fantastic. Okay. So from there, take us all the way up to just prior to joining the AIC, please, Richard. I'm trying to just
yeah, of
convey
course.
the volume and the vastness of the experience that you've got that you bring
Yeah,
to
I mean, one of
Foresight.
the fascinating things, just sticking with EC Soft very briefly, one of the fascinating things there was they were dual listed NASDAQ LSE, had floated. I think they were the first business to dual list. And on IPO, about 5 institutions bought the stock, relatively little secondary trading. The share price drifted. They ended up at a discount to the cash on the balance sheet and got bought out for less than the cash on the balance sheet. So by a company called Cyber, which is an American IT services business. So yeah, just showed you the importance of, you know, looking after and thinking about the secondary market, the dynamics of supply and demand, and how you manage a business in those circumstances, all of that kind of stuff. So yeah, and I left there and joined a business called Huntswood, which originally was a recruitment business, but effectively provided people into, had morphed and provided people into the large banks and elsewhere to deal with mortgage endowment complaint handling primarily, or other regulated complaint handling. Grew that business. 3i came in as an investor shortly after I joined. I was there 3 years. I think we grew from about 100 people to about 600 people in that time. Opened offices in Manchester and Scotland. I also, as part of my time there as FD, had a sort of business development role as well, and won some business with the NHS, handling NHS complaints, because in many ways they're quite similar to financial services complaints, because they're quite heavily regulated, and you're often dealing with customers in relatively distressed scenarios and things. So yeah, that was an interesting business, and left there and joined the Share Centre. And I joined the Share Centre as FD. It was a private business at the time. We floated the business on AIM, so it was 2006. We floated the business on AIM in 2008, and then end of 2013 into 2014, the opportunity came up that the chairman, Sir Martin Jacob, retired, and Gavin Oldham, who'd set the business up, became chair, and I then moved up to be CEO behind him. Put in place a sort of partnership strategy to grow the business. So we started doing the share dealing for Computer Share, certificated dealing for Barclays and others, you know, really using the engine that we'd built to provide those services to other brands as well as our own. And eventually in 2020, just before the pandemic, announced that we were being sold to II, and we sold that business to Interactive Investor, who were on their kind of buy and build strategy at the time, before they themselves sold out to Aberdn. So Yeah, that was, as I said, I think I've kind of seen capital from most perspectives, whether as a kind of auditor, analyst, private equity at Huntswood, through flotation on the market onto AIM with the share centre, through to selling that business. I mean, that was lively in itself because we announced that we were being sold, or we'd agreed a sale end of February 2020, just as we then went into lockdown in March 2020. And we literally
Amazing timing.
morphed. We had 250 staff in Aylesbury, and we literally morphed into being a remote operating business in the space of about 3 weeks, which from a technology point of view and all the regulatory stuff around recording phone calls and everything else, if you'd have said that 6 months prior to that, that's what we were going to do, I'd have probably laughed at you. But yeah,
Amazing.
but yeah, what I've seen in that sense in terms of capital is phenomenal, but also the power of capital and the power of engagement and engaging people with capital and those sorts of things, I think are some really important lessons which then translate across into the investment trust space,
Absolutely. Now, thank you for sharing all of that. And I must say, having interviewed Gavin Oldham, OBE, I can imagine that you and him were absolutely on it in 2020, and to have achieved that in such a small window of time.
Yeah.
I'm not surprised. So
I
very
think
well done with that.
one of my strangest experiences in that whole far too long career was the shareholder meetings dealing with the sale of Share Plc, where it was literally Gavin and I at opposite ends of our boardroom table in Aylesbury, with nobody else in the room because of COVID, the lawyers and a few shareholders online on a webinar reading a script that we'd been provided with so that we made sure that we did what we needed to do. Yeah, some very strange experiences given the nature of the times, but yeah.
No, that's absolutely excellent execution as well, given the way where Share PLC started as well. Now, Gavin, I'm conscious that I've covered quite a few salient points. I've interviewed your amazing colleagues, Annabelle Brodie-Smith and Nick Britton. So I want to focus our attention now on AIC and some of the pertinent issues, salient points, reforms you're looking for, and so on and so forth. I'm going to go through these sequentially, so you've got plenty of time to cover them off. Okay. So, firstly, just for our global audience, please could you share with us the sheer size of the AIC's business, the members, the combined AUM, and some cover over regarding the amazing team that you've got as well, please.
Yeah, of course, Peter. So first thing to say is it is an amazing team. So the sector's been around since the 1800s. The AIC itself was founded in 1932, I think. So we're not far off getting to 100 years as a trade body, which in itself is quite a milestone. Today we've got about 331 members. They've got about 250 billion of assets between them, based on NAV. That's out of a sector as a whole that's probably about 275 billion. Over 90% of the sector are members of the AIC. So, I mean, how I like to portray that is to say that, we have a very closely defined criteria to be a member. You have to be a closed-ended investment company, you have to be listed on an exchange, you have to offer a diversified portfolio, etc. So but because of that, because of the tightness of the definition of our membership base, we're able to take very strong views and represent the industry and the sector very strongly. We're not having to satisfy a wide range of disparate views or disparate interests. And it's perhaps worth saying that our members are the investment companies themselves. So the asset management groups, the brokers, etc., they're not members. We don't have a sort of affiliate or associate membership model. It is purely the companies themselves. And to the extent that that then becomes people or members in that sense, it's the non-executive directors of those, of which there are about 1,200. So yeah, that's the nature of the organisation in terms of its membership. In terms of the people here, we've got 22 people now. So me and a team of 21, many of whom have been here for a long time and are very well versed in the industry, have huge amount of experience and knowledge. And so, yeah, I'm very blessed as a relative new boy joining the organisation to have that kind of experience. Some of which, as you say, you've interviewed already on your programmes. But yeah, it creates a very strong organisation and a body of knowledge which is almost second to none, really. So yeah, I'm very lucky in that sense.
Indeed. I mean, I'll speak about the website a bit later on and the quality of content you've got a bit later on. But I wanted to just point this out as well, because on a different platform entirely, my own platform, I interviewed Annabelle Brodie Smith for the very first time in June 2016, and the assets under management for investment companies via the AIC was only 65 billion then. So for the fact it's gone from 2016 to 250 for your members is an astonishing rate of growth over that period of time. So congratulations on that.
Yeah, I mean, the sector has seen huge growth, and there's two main reasons for that. One is market performance has been helpful, clearly, so that's helped those assets. And the second is the level of capital raising. And you'd look at that, I think, in two ways. One is existing mandates raising more because they're being successful, they're trading at a premium, and they're getting to the point where they can attract more investor capital in. And the other is because the sector's, as it has always done since it first started in 1868, it's always innovated and developed new offerings for customers, identified new asset classes. And in the last 10 years in particular, we've done that in areas like infrastructure, renewable energy. You'll have seen many of the different sort of asset classes, private equity, property, etc. You've seen those less liquid assets coming to the fore. So perhaps certainly as the number of companies listed on the main market has declined, as private capital has sort of benefited from low interest rates and growth, actually the investment company, and this is perhaps a theme we can pick up on, but the investment company has kind of sat there as the bridge and opened up some of those opportunities for investors to access. So I think that's part of the reason why you've seen that quite significant growth over that period of time.
Indeed, thank you for that. And this is despite, to quote your colleague Nick Britton, 2023 was a very challenging year for investment trusts, with the average discount reaching its widest level since the financial crisis. In your view, Richard, could investment trusts have seen the immediate nadir and are better times ahead for investment trusts?
Yeah, I mean, just to pick you up on that slightly, so the 250 billion and that we're talking about is the NAV, not the market value. So yeah,
No,
market
absolutely. Yeah.
values may suffer from discounts, and you're right. As you say, 2023 was a challenging year. We saw in the last 12 months we've seen relatively little in the way of capital raising. We've seen discounts at relatively wide levels, in part because of the dramatic shift in interest rates that we saw. As this tightening cycle, I think, is the most rapid tightening cycle that the economy's seen, certainly in the last 40 or 50 years. And therefore, investment companies that were yielding 6 or 7% that looked attractive when interest rates are 0.5% suddenly look decidedly less attractive if your risk-free rate is 6%. So inevitably that had an impact. But I mean, I think the key point I would say, answering your question about have we seen the nadir and is it better times ahead, fundamentally the investment company structure is about long-term investment and performance. And you will get periods of volatility, you will get fluctuations in the discount rates, and we've seen that in the last 12 months. But over the longer term, the structure, for inherent structural reasons, has the ability to outperform, has the ability to deliver for investors, and that will come through. And so you would expect those discounts, as we have actually seen in recent weeks and months, those discounts to narrow a bit over time, to come back in, more fundraising, other ideas. The sector will continue to innovate, finding other asset classes, etc. So, yeah, I think there's every reason to be optimistic looking forward.
Brilliant. And that optimism is carried over by Finsbury Growth and Investment Trust Manager Nick Train, who recently said the UK market is pregnant with value and opportunity, which I'm sure you agree with.
Yeah, absolutely. And in the investment trust space, you've also got to remember that you have sitting on every investment trust, you have a board of directors sitting, an independent board of directors sitting there to look after the shareholders' interests, and they have been particularly active in the face of the things that you've been talking about in the last 12 months. So you've seen more mergers, more manager switches, some managed wind-ups where the board concludes that actually, it might be in better investors' interest to return them their capital and allow them to invest it elsewhere. So you've seen boards taking those active decisions and managing that value as well for investors. So as I said, I would definitely agree with Nick that there's every reason to be optimistic.
Thank you for that. Now, one of the things that has been broached here on previous conversations with others and in the press is the talk about the potential launch of the British ISA. Now, I want to speak to you about the potential, there's talk in billions here that could be added to the investment arena. Obviously, investment trusts will be boosted by that. What are your thoughts on the British ISA, the potential time frame for them coming to the fore, and the impact it could have on the investment trust sector? Please, Richard.
So I think there's kind of two answers to that question. One is the specifics relating to the current proposals, and the other is the sort of broader point about what it could do to the market. So let me take the first one, deal with some of the specifics. I think in its current proposal, it's potentially a bit disappointing because it could be. I should just unpick that and say the British ISA is something that we've suggested and supported in our budget submission. We suggested it, but I think there's a risk of the perfect getting in the way of the good, if you like. There's a risk of trying to make it too precise and too complicated, and I think, particularly having come from a retail platform background, I think if you start putting in place criteria as to which companies are eligible, not eligible, trying to work out where you can and can't invest and all the rest of it, it becomes so complicated both for investors and platforms to manage that actually it loses the ability to deliver what's hoped for in terms of the overall objective. So, I mean, I think for the first thing I would say is that we basically want the rules set that any UK listed or quoted company could be included in the British ISA. The fact that that company's revenue, business, assets might be overseas, I don't see as a particular issue, because if you think about it, if a US company wants to come and list in London, and there's been much made about companies going in the other direction, are you then going to say, yeah, come and list in London, but we're going to stop a significant proportion of the investor community investing in you? Or if you say, if you take the view that actually the purpose of this is to try and help reinvigorate the London market, bearing in mind that the number of companies is declining, has been declining quite significantly, etc., then one of the fundamental risks to London is that we lose the expertise around the market, so the brokers, the lawyers, etc. Even if the company itself is investing its assets overseas, the fact that it's listing in London, the fact that it has directors here, has a base here, has a broker here, has corporate finance advisors, lawyers, everybody else, that is helping support the infrastructure, which then helps drive the market itself. So the market gets a benefit. So if the overall objective is to reinvigorate the market, our view is that both from an investor point of view, to make it as simple and easy to understand, as well as a sort of broader benefit perspective, any UK listed company should be included. So I'd encourage anybody to lobby on that behalf, and thus include all investment companies within that domain as well. I think if you just take a step back there and you look at the broader point and the impact it could have, which was sort of your broader question, for me, it's about engagement and encouraging people to invest in the domestic market and how you go about engaging people more. And I think the British ISA is a good, is sort of good signaler of intent in terms of trying to encourage people to do that more and to think about the domestic market more. But fundamentally, the question is how you go about engaging people more with equity, how you go about encouraging people to save and invest more and be active in that pursuit. So yeah, it's a good step, but it's probably a first step on a journey, I would say.
Fantastic. Love that reply. Thank you, Richard. Now, let's talk about the issue of cost disclosures, Richard. You stated recently that, and I know it's a big issue for you right now, so I need to get this in the middle of our conversation, so it gives you as much time to talk about it. You stated recently it's clear that the issue around investment company cost disclosure are harming the industry and putting off existing and potential investors, and you've called on the Treasury to urgently address the issue. Firstly, for those that are unaware, please can you expand on this issue, its harm, impact, and the possible resolutions that the AIC seeks, please, Richard?
So yeah, absolutely. So there are. Let's deal with the issue and just a bit of an explanation as to what the issue is first. And the way I would characterise this is to say that there are effectively three elements to this, and I'll try and make it as simple as possible because it's quite easy, as you'll well know from the financial services industry more broadly, to suddenly end up talking in three-letter acronyms and abbreviations and technical terms, which I have every sympathy with people that it becomes very confusing very quickly. So I'll try and keep it as simple as I can. There are effectively three aspects to this. First is, what does an investment company disclose or have to disclose as its costs? And the regulations at the moment, which effectively require a single figure to be disclosed, result in misleading disclosure because not least they force the disclosure and inclusion in that of costs which aren't really a cost associated with asset management, for example. So, if you are running an infrastructure fund, a renewable energies fund, and you've got real assets, which many of our members now are invested in, sort of real assets, and you're having to maintain and look after those assets, those costs would be included in the costs you disclose. As well as the costs of the actual asset management itself. So it's kind of inflating the cost. And if you are thinking about that particular part of the investment company universe, if as an investor you're looking for exposure to a particular asset class and your choice is between the investment company or perhaps a trading company that's operating in a similar market, the investment company has a cost which it's disclosing, the trading company doesn't. So again, that can put people off unnecessarily. But so there's what does an investment company disclose? There's then where investment companies are used by wealth managers, fund of funds investors, other investors as part of their portfolio, the current rules require them to pull through what's called the underlying costs or the costs of the funds that they're invested in and include those costs in their own costs. So, and again, this sort of double counting sort of inflates the presented cost to the investor because actually the cost of those underlying investments is included in the return, and particularly in an investment company where that fund of fund manager or wealth manager is investing at a share price, and effectively the costs are all wrapped up in that return. The investor in that sort of top vehicle, that wealth management portfolio or that fund of funds portfolio, is not bearing those costs. They're born within the return within that fund. So again, that overinflates the disclosure. And then the third element, so you've got what investment companies disclose, what users of investment companies have to disclose. The third element is what's disclosed to retail investors. And some of that is just plainly nonsensical. So for example, you go onto a platform and you've got you get presented with a total impact of costs illustration. And the platforms they present that using a range of or using a number of relatively common assumptions, typically 5% growth, which is fine. But we have members taking the private equity sector, for example. You might have a member who is using other limited liability partnerships or other private equity vehicles that they're investing in. So the first part is that they're having to pull through those costs, which, as I said, doesn't make sense in the first place. The second thing is then when you come to the retail disclosures, their disclosed costs might be, say, 6%. But that's because they're including performance fees in their underlying investments, they're including a cost of gearing, etc. when you compare that to a standard, let's assume you get 5% a year growth in the market, your 6% cost, your illustration tells you you're going to lose money at every point. Clearly that's nonsensical, because actually, if you only got 5%, you wouldn't be paying any of the performance fees. There's no account of the fact that the gearing is amplifying the return that you're getting, or, so yeah, that just needs major reform. And I think also the way that they're presented to a retail investor, they are described as costs. You're almost given the impression, some would argue you're directly given the impression, that it's something that's going to come off your investment. But actually, you're investing at a share price. It's, you haven't got this yet to pay. It kind of gets wrapped up in your return. So some of that, the way in which that's displayed, the way in which that's presented, some of the terminology around that isn't right. So there are those three aspects, I think, that it's important not to decide on. Now, without getting unduly technical about it, effectively the government put, post-Brexit, put all of the EU directives into UK law, and is currently going through a process of repealing that law and passing the powers to make the rules across to the FCA. So the first part of that around consumer disclosures is currently going through that process. And we've argued that investment companies should be taken out of scope of regulated cost disclosure. And what would that mean? Well, first of all, what it wouldn't mean that we don't have any disclosure, because investment companies have to produce annual reports and accounts. We have to, and historically, before a lot of these rules came into place, which was about 2018, many investment companies disclosed costs anyway. So they voluntarily made those disclosures because investors wanted to see them. So the idea there would be no disclosure is just not the case. The data and the information is there for investors to see. But we want to go back to that situation. What we've also said is, in terms of the sort of second and third problems that I identified, there should be an end to aggregation. So you shouldn't have underlying costs pulled through into the overarching cost. And if we just sit on that idea for a moment, if you think about most of the things you buy in life, think about your home, broadband, TV, telephone, etc. It's generally accepted that bundling of costs doesn't help competition. And the same is true in financial services. The asset management review the FCA undertook said that there needed to be a brighter light shone on the costs of asset management, and at the moment that wasn't really happening. If you bundle all of those costs into one, the ability of the investor to see that cost is blurred. And the best way to do that is to illustrate it with a particularly ridiculous example, which is if you invest in a FTSE 250 tracker, for example. There are now about 90 members of the 90 investment companies, members of the AIC, who are in the FTSE 250. So in theory, the FTSE 250 tracker should be pulling through a little bit of cost relating to each of those and including that in their cost figure. So if an investment company, a member of the AIC, goes in or out of the FTSE 250, the cost of that tracker should in theory go up or down, the disclosed cost. It makes no difference to the investor. The investor's not paying any more or less, so it's not representative of something that the investor is incurring. And what does the investor want to know? If I invest in a tracker, I want to know what's the tracking error and how much am I paying the manager to track. I need to see that figure. That's what I want to know. So pulling through those underlying costs makes no sense in that context at all. So to the extent that the rules are rewritten for those people using investment companies within their investment portfolios, it needs to stop that aggregation. And then the whole retail disclosure piece needs seriously looking at in terms of the presentation of information to retail investors and what retail investors are seeing when they go onto the platforms in terms of costs disclosed and illustrations and the like. So yeah, that's hopefully I've tried to use language which is not not too burdened by regulatory acronyms and the like. But that's the sort of problem and our recommendations in a nutshell.
Thank you for that, Richard. Thorough response, and very clean, plain English was on point there. Thank you very much. Now, another thing that's burdensome for investment trusts and it's a topic I know that near the top of your agenda and AIC's, is the issue of stamp duty on investment trusts. What actually, obviously you want it scrapped, but how quickly could we see this taking place in the sense of actually getting the Treasury and the FCA to actually see sense?
If only I could wave a magic wand, I'd love to. Yeah, the issue of stamp duty is a perennial one. It's been around a while. I mean, fundamentally, it's a tax on liquidity. It's a tax on the market, and it needs to go. And you've seen many other countries around the world. I think even China were one of the more recent ones to get rid of those sorts of stamp type taxes on liquidity and trading. How quickly? Difficult to say. I mean, the problem is that there is no money in the public purse at the moment. So anything you're taking to government and saying this is a cost or a revenue cost, then there's a challenging reception because they just don't have the money. But there is a precedent. I mean, I think for our sector in particular, I think there's two things I would say. One is there are more grounds to exempt investment companies from stamp duty than any other equity. If you were looking for a particular sort of slightly more surgical approach, you could just exclude investment companies from stamp duty. And the reason for doing that is because of the double counting and the fact double taxation, rather, the fact that the investment company itself is paying tax when it buys the equities, and then the investor is then paying the stamp duty as well. So you've got double taxation effectively, which is generally recognised as being a bad thing, obviously. And you've also got the comparability with the open-ended sector where you're not paying stamp duty. So you're not paying stamp duty to buy a unit in an open-ended vehicle. So there's two good reasons there. And then the other thing I would say is there is a precedent. So when I was at the Share Centre, we campaigned and we were successful to get stamp duty, I'm not saying this was entirely down to us, but stamp duty lifted on the trading of AIM shares. So the government has historically, that's an example of them taking it off of a particular part of the listed market, with a view to trying to encourage, more dealing, more companies to list, invigorate the market, etc. If the view is the London market needs a stimulus and needs reinvigorating, then hey, removing stamp duty would be a help to that. Is it the silver bullet? Probably not, but it would certainly help in terms of liquidity and removing that unnecessary impediment. But particularly for investment companies, I say, if you're investing in some of our longer standing members, global equity type mandates where you're investing in other listed equity, and as an investor your choice is between that and an open-ended vehicle, then why do you have to start 0.5% down just because you've chosen to invest in the investment company? Doesn't make sense.
Absolutely. I mean, in complete agreement with you as well, Richard, there on that one. Now, you touched on briefly about consolidation. We've got consolidation in the wealth management industry. We've got consolidation and mergers amongst the investment trusts. But I'm going to skip over that and just ask you really about creating the liquidity via that consolidation process by looking into the IPO and the listing regime for investment trusts. How can that be simplified? And how can that be improved to offset the consolidation we're seeing?
Yeah, I mean, I think the first question to ask is why we're seeing that consolidation, and I think partly that's around scale and the drive for more scale. There is both a perception and a reality that larger scale equals more liquidity, and the data would support that as being the case. And as you said, if you've got consolidation of wealth managers, they're looking at moving larger pots of money around, and it's not actually just the consolidation of the firms themselves, it's the fact that their investment propositions are becoming more consolidated as well. So you're getting more centralized investment propositions, more centralized buy lists, etc. So that's resulting in larger pots of money being moved around at any one time, thus requiring more liquidity in what they're investing in. So it's really about that. So I think I think you've got to understand that as being the driver when you then come to say, well, what about the IPO market and new investment trusts? I think, new investment trusts coming to market, they've got to have a degree of scale already, or they've got to have some kind of path that's going to take them to scale. They've got to have some kind of USP or particular selling point that makes their proposition, their investment thesis distinct and attractive. And I know in the investment trust press, in the broadest sense, much is made of the fact that we haven't really seen an IPO since March 23, so probably more than a year now. The reality is we haven't seen really any IPOs of any scale or nature in London at all. So it's not. I see that as a market issue rather than as an investment trust issue, and I think that will open up again. There are the managers out there with the ideas and things, but you've got to have market sentiment as well. These things don't just operate in isolation, and the discount levels don't help either. You if you've got an idea and you want to bring it to market, and the investor can buy access to the same asset class at a 20% discount, well, why pay £1 for £1 when you can pay 80p for £1 in the market today? So the discount levels and things don't help in terms of that IPO market. So as those narrow as well, I think you'll start to see more of that coming to the fore.
Brilliant. Now, one of the things I've recently noticed was the broadening of AIC's pool of external research to build awareness for investment trusts for all investors of every single class. Please, can you explain to our global audience what's happened recently? I'm talking about the additional research from Edison, Hardman and Co, etc., because that's really going to help with the education of investment trusts as well.
So when I joined the AIC, I put in place a vision and a mission statement, and without getting too sort of corporate speak about it, our vision statement is for investment trusts to be understood and considered by every investor. And critical to that, to me, is our website, and we sort of redeveloped and relaunched our website, and part of that is making that the place to go for everything investment company related. And every investment company has a company profile page on our website. And you can go there and you can find out anything about that investment company. And part of what I want us to do is to pull together any third-party content that's relevant for investors as well, so that they can go there and they know they're seeing pretty much as they can, as much as exists on that company in terms of doing their own research. Paid for research is, we said earlier in the discussion, I was an equity research analyst myself, not in the paid for space, but in the investment banking space. But I know what the value of paid for research is. I was a client of paid for research when I was at Share as an AIM company. We didn't really have much research written on us, so we paid somebody to write us. And the one of the joys with paid for research is that the conflicts are clear and evident. It's paid for by the company. Everybody who's reading it knows that. There's no kind of hidden agendas as to why it's written. There's no recommendations on it, so there's no issues there either. And so it's a really important part of the market for retail investors, I think. And so we've been working with, as you say, the likes of Kepler, Edison, Hardman, Quoted Data, etc., to bring through as much of that information as we possibly can. The website's a hugely rich, very data-rich technical resource, but aside from crunching the numbers, which I know many investors do thoroughly enjoy doing, actually seeing some of that more qualitative stuff and seeing the news flow and having that curated in a way that's relevant to the company you're researching, pulling together as much of that research as you can, all of that's really important, and so that's what we're trying to do.
Doing a fantastic job as well. Just for our audience, we just send them to the website now and just give them where to find you, please, Richard.
Of course, it's dead easy. It's just the AIC, so THEAIC, and then .co.uk.
Thank you very much. Now, today, I've just grabbed it before I came on air with you, was the announcement by the City Wire that they've launched the Investment Trust Fund Manager Ratings offering as well for investors to utilise another important tool to access information and be made more aware of listed investment trusts. Can you just share that one? Because I know it's something that Annabelle Brodie-Smith, your communications director, has been passionate about for some time.
Yeah,
It's come on board.
it's a really good and encouraging development, and I think actually it plays into this idea that more people are writing research. There's more research out there,
Absolutely.
more people paying attention to the sector, realizing the value of the sector in enabling investors to diversify their portfolio, access different asset classes, etc. So Citywire already rate managers of open-ended funds, and now they've seen the light and added closed-ended funds to, or some closed-ended funds anyway, to their portfolio. I think they're focusing initially on investment companies that invest in equities, so other listed equities. So not at the moment looking at the private asset ones, but the listed equity ones. And yeah, it's a great development, and for the retail investor in particular, but I mean, it also helps the advisors and the wealth managers, but for the retail investors in particular, all of this stuff kind of adds to their wealth of information that they can draw on when doing their research and filtering and deciding the ways in which they want to narrow down their choice. It's a bewildering choice when you walk into a supermarket and you've got a shelf with thousands and thousands of different versions of the same product. That's effectively what financial services does to its platform. It's like, okay, you want to invest, you should invest, you go onto a platform, and then it's like, okay, so now what do I invest in? And you're presented with this array of literally thousands of options. I mean, it's vast. So anything that can help investors navigate that, curate that journey, decide which ones to invest in, narrow the universe so they can focus their research a bit better, all of that's got to be applauded, and the Citywire piece is another part in that mix.
Brilliant. Thank you for that. Now, having spoken with Annabelle Brodie-Smith and Nick, I want to get it from you as well, Richard, as to why investment trusts, the uniqueness of them, the reasoning for long-term investing, and why everyone should consider having them to their investments, including pensions, etc.
Yeah, I mean, I think there are a number of structural benefits as to why the investment trust sector. The fact that, and I'll try and reel them off relatively quickly, but the fact that the investment manager is fully invested. They don't have to worry about redemptions and creations, so they don't have to carry liquidity or a cash buffer. So you're getting the full benefit of access to the underlying assets. The fact they can smooth their income. So we've got a significant number of investment trusts that have increased their dividend in absolute terms for the last 20 years. I think we've got 8 that have done it for over 50 years in a row. So you've got that ability to manage income through good and through bad, which is really valuable, particularly for investors looking for yield and income. The ability to gear and borrow. So at the moment we're seeing opportunities where, because of discounts, managers can't necessarily, or investment companies can't necessarily raise more capital, but they can gear up if they're seeing opportunities to buy assets and deliver a return for investors. So you've got that ability within the investment trust sector. The ability to hold illiquid assets, to go further down the liquidity and scale spectrum, so you can get access to some of those smaller, more exciting companies that are going to provide some of that extra growth in terms of your portfolio. All of that, the diversification that they can bring. There's a huge range of reasons why you would want to include in investment companies, and the importance of long-term investing and the access that investment companies can give you to some of those themes, I think are really important for any investor.
Thank you for that. And you're so succinct as well, because we're running out of time. But despite running out of time, I'm going to ask you this question because I think it's absolutely fantastic. When I found this, you mentioned pensions, Richard, and there is a thing here where you said that there's something you would change about pensions immediately.
Me, yeah.
What would that be, and why? I just
I
love it.
wouldn't.
Please share.
I wouldn't call them pensions. They're not a pension.
Absolutely.
I think in this country you move from defined benefit to defined contribution schemes. A defined benefit scheme that your parents may have had is a pension. That will pay you a proportion of your income for life. That's a pension. We don't have that today. We have defined contribution schemes. It's a pot. It's a long-term savings plan. It should be called a long-term savings plan. And it goes back to something I touched on earlier about how we get people to engage with their savings and investments.
Absolutely.
And if you walk out onto the street and you start talking to people about pensions, they glaze over, probably walk off actually. But whereas if you talk to them about long-term savings plans, this is your defined contribution pension that you're in probably through your workplace pension at work. You probably tick the default box. You'll be in a relatively low-cost tracker. giving you some pretty anodyne exposure to world markets. You need to care for it, you need to nurture it, you need to work out whether you're contributing enough. All of those things, you've got to bring that to life, and people have to engage with that. And when you look around the world, you look at the superannuation scheme in Australia, you look at the 401k in America, people talk about those over the dinner table because they're part of the daily conversation and they're part of life. Here, you mentioned pensions, as I say, people just switch off. It's something for the future. It's not to be worried about. Don't do it, whatever. They just don't engage. And we've got to address that. And I think fundamentally we have to square up to people that the risk has gone from the state and the employer onto the individual.
Yes.
Which I don't think has ever been properly explained to people. And you are sitting on that capital risk. You've got to grow that pot to give yourself enough money for a retirement at some point in your life, assuming that's what you want to do. And you've got to engage with it. It's not just going to happen by magic. And I think changing the terminology and the way it's all referred to is a fundamental part of that. And a very simple part and relatively cost-free.
Brilliant. Love that. Love that. Thank you ever so much for sharing that. And you've got my vote anyway. So,
Thank you.
You've got lots and lots of people's vote that would change that, definitely. Now, Richard, I'm conscious of the times. I've got one final question for you. Richard, as the chief exec of Association of Investment Companies, you've got a team, and you're also, I can see clearly, very passionate about communication and the investment companies, educational experts that you've got throughout the business. Having joined in 2021, what are you most proud of what the AIC has achieved thus far?
I think if I was to pick out one thing that was an achievement from my 2 years, has been the introduction of the major retail investor event that we now hold every sort of October time, and we're holding again on the 11th of October this year. Putting 30 or 40 fund managers on a platform, various single speaker panel sessions, and opening that up for retail investors, both in person physically and online. And that kind of showcase event, getting that message out there, that for me is what it's all about, really. So that would be the number one thing I would highlight.
Fantastic. Richard, thank you ever so much. Ladies and gents, that was Richard Stone, the CEO of the Association of Investment Companies. Richard, thank you ever so much for being on this Investing Matters podcast with me. Love to the team, and I look forward to seeing you in person very soon.
Thanks, Peter.
Take care. God bless you.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.